Hello everyone, welcome to JAIIB CIB Prep. In today's video, we'll discuss about Unit 2 and more specifically about the offense of money laundering, stages of money laundering, what are the object of Prevention of Money Laundering Act, what is the money laundering offense, punishment, how banks control the offense of money laundering, what is the organizational setup with regard to anti-money laundering, what are the obligations under Prevention of Money Laundering Act, obligation under international agreement, what do we understand by correspondent banks, so on and so forth. So without further ado, let's start our video. So, what is money laundering? In simple sense, it is to make dirty money look clean. What do we understand by dirty money? The money which origins from illegal activities. So, money laundering is nothing but hiding the original origin of illegal money and making it legal. For example, a drug dealer earns money through illegal drug sales. Now, he does not want anyone to know it's illegal. So, he deposits the money into a bank in small amounts or invest in a property to make it look like he earned it legally. So, as the name suggests, money laundering is you are laundering the money to make it clean. So, to make dirty money look clean. You may come across with certain terms like terrorist financing as well. So let's understand it. Terrorist financing means raising and using money to support terrorist activities. Examples, if someone donates money to a charity that secretly supports a terrorist group. Now, this charity looks legal, but it's just a cover. It is terrorist financing. And money laundering and terrorist financing, financial crimes, they are somewhat connected. All three are often done by the same people or groups and use the same tricks like fake identities, multiple accounts, secret transfers, so on and so forth. Now, who will fight this money laundering and terrorist financing globally? So, there's an organization known as FATF. This is an organization which gives rules to countries on how to stop money laundering and terrorist financing. Now, these rules issued by FATF are known as FATF standards and 2012. Now, let's understand about the stages of money laundering. Uh, in the offense of money laundering, generally there are three stages involved. Number one, placement. Number two, layering, and number three, integration. In placement, a criminal puts illegal cash into the financial system. For example, he deposits small amount of illegal cash into bank account. So he's what he's doing, he's placing his dirty money, his illegally gained money into the system. Now, in next step, what he does, he moves the money through many transactions to hide its source. He transfer the funds between multiple accounts to create a web, to create a layer in order to hide the origin of the money. And third, integration. He uses the money legally. He buys a shop, he invests in real estate with the laundered money. So what he does, he introduce that illegal money into the system, making it look like it's clean money. All right, let's move on to stage of financing of terrorism. Now there are four stages involved in terrorist financing. Number one, raising. Uh, when we say the term raising, we generally speaking about the collection of funds from supporters or illegal businesses. For example, there were fake donation campaigns or smuggling, so on and so forth. Number two, moving. In moving stage, the funds are transferred to the terrorist group using hawala or wire transfer. Once they are moved, they are stored into some foreign bank accounts, and generally there is a cooling off period. Money is stored into the accounts and it remains there for some time. After the cooling off period, the money is used on terrorist operations, used for terrorist operations on terrorist acts like buying weapons or funding training camps. Now, we need to stop this money laundering. We need to stop this terrorist financing of terrorism. So, we introduce Prevention of Money Laundering Act. So, what are the objectives of anti-money laundering? You are against money laundering, you want to prevent it. So number one, you stop criminals from using banks, you protect society from criminals, you keep the economy safe, and you block terrorists from getting funds. So these are the core objectives of anti-money laundering. You stop the criminals, you protect the society, you keep the economy safe, and you block terrorists from getting funds. Now let's talk about India's anti-money laundering system. India passed a law called Prevention of Money Laundering Act in 2002, PMLA 2002. So this act was enacted in the year 2002. These in anti-money laundering system in India are FIU India, Financial Intelligence Unit. It collects and analyzes suspicious financial data. Then we have ED, Enforcement Directorate. It investigates and arrests money launderers. We have special courts to deal with money laundering cases, and the special court can freeze or take away illegal property. Then we have regulators. These regulators like SEBI, RBI, they issue rules for banks and businesses to follow. Now, what is the offense of money laundering? It has been defined under Section 3 of the Money Prevention of Money Laundering Act. It simply states that if anyone tries to use money for a crime, if someone helps uh, someone else to do it, or pretends that illegal money is legal money, he or she has committed the offense of money laundering, and they will be guilty of the offense of money laundering. Section 4 of the Prevention of Money Laundering Act provides for the punishment. It states that if anyone commits the offense of money laundering, then he or she shall be imprisoned for a minimum period of 3 years, which can goes up to 7 years. And if the act is drug related, if it is connected with NDPS Act, then this maximum imprisonment can go up to 10 years. And this offense of money laundering is non-bailable and cognizable offense. Keep that in mind. Money laundering is perception. So criminals exploit the financial products. What increases the risk of money laundering, uh, terrorist financing, is that there are unknown or suspicious customers. Then there are certain products like wire transfer, prepaid cards. It makes life easier to wire transfer, but again the criminals use it for the uh, destruction purposes, to harm the economy, to harm the harmony of the countries. Then there are transactions linked to risky countries, then there are high value or unusual transactions, location of the bank or its customer. So these factors increases the risk. So risk mainly depend on the type of customer, nature of the service or the product, transaction, where the branch or the bank has been located, what is the value, what is the type of transaction. So risk generally depends on these things. So a criminal opens a bank account using a fake identity, and if he sends money overseas frequently without business reason, then this is a red flag. Bank need to keep a check on it. Now, how does banks reduce this money laundering or terrorist financing risk? So they do follow KYC norms. By KYC, we mean know your customer. You understand your customer identity. You understand your customer's income sources. Then you monitor transactions. If any transaction looks suspicious, you report it. And report it to whom? FIU, Financial Intelligence Unit, the one we have just discussed before. Financial Intelligence Unit. Then you train your staff on these anti-money laundering procedures. You teach them how to spot and how to handle these money laundering and terrorist financing risks. and you comply with all the legal and regulatory norms. So bank adhere to all the relevant laws and regulations to prevent the risk of money laundering. KYC policy. KYC simply means you verify who your customer is. It helps bank make sure that they are dealing with real legal people and not criminals. KYC prevents misuse of the banking system for money laundering or terrorist financing. So you understand what is KYC. Now introduction system was the old practice. So before KYC rules, before 2002, bank used to open a new customer's account only if someone introduced them, like an existing customer or a staff member who knew them well. It gave the bank some protection under law, Negotiable Instrument Act, in case of fraud. But now this practice has stopped. RBI's 2002 guidelines say no need for introduction, only proper KYC verification is required, right? So who is a customer? Now this question arises. You need to know your customer, but again, who is a customer? We have already discussed it under uh, in unit 1, if you recall, that a customer is anyone who uses any financial services, even just once. Then also he or she is a customer, and it also includes beneficial owners. Beneficial owners meaning to say people acting on behalf of someone. Uh, then they are also included. Now, who are considered as customer? Just an examples are people with bank accounts, FD, loans, credit card, anyone doing remittances using the bank account, people having DMAT, PPF, pension fund accounts, users of insurance, mutual fund, locker, safe custody, and beneficial owners. Are real owners behind a business and clients of intermediaries like brokers or lawyers. They all are considered customers. And every bank must have KYC policy. KYC policy is a rule book for customer checking and monitoring. KYC policy includes four core elements. Number one, customer acceptance policy. It decides whom to allow as customer and under what conditions. For example, you don't open accounts for fake names or suspicious backgrounds. Number two, customer identification procedure. You verify the person's identity and address using valid documents. So Aadhaar card, passport, voter ID. So you uses these documents for identification purposes. Number three, risk management. You classify customer as low, medium, or high risk. For example, a salaried person is a low risk. A large cash dealer is a high risk. So politically exposed person is a high risk. Monitoring of transactions. You regularly check for suspicious transactions. For example, a sudden deposit of 1 crore rupees in a student's account, though this seems suspicious, right? So this is a suspicious transaction. You monitor these kind of transactions. Now let's move on to organizational setup for anti-money laundering. Bank must have special officers to ensure anti-money laundering laws are followed. And in hierarchy, we have a designated director. Designated director is a senior person, a managing director, trustee partner, and he is responsible for the overall compliance with money laundering laws. So if a question comes like who is responsible for full compliance with money laundering laws, it is designated director. Then we have principal officers. Apart from complying with overall money laundering laws, designated director has some key duties like keep the policies updated, ensure staff is well trained, adjust system with changing risk patterns, set up proper system and teams for KYC or anti-money laundering. Principal officer is also known as money laundering reporting officer, right? And principal officer ensures that KYC or AML policies are followed. Suspicious transactions are reported to FIU India. Um, this is the duty of principal officer who reports these suspicious transactions. It is the principal officer. Then regular reports are sent to management, coordination with law enforcement. These are the duties of principal officer. Number third, AML team. A team is created in each bank for updating the KYC policy, for helping departments with customer verification, for assessing risk, monitoring customer transactions. and for sending reports to FIU IND whenever needed. So these are some of the duties of AML compliance team. Obligation under Prevention of Money Laundering Act. Now, a bank has certain obligations, like bank has to verify identity of customer and beneficial owner. For this purpose, bank uses Aadhaar card, passport, or other official documents. Banks are required to keep a record of all transactions for a period of 5 years and all the identity proof and documents for 5 years after account is closed. Okay, so 5 years after the end of relationship or account closure, these documents have to be maintained. The identity documents have to be maintained. Bank have to keep all the information confidential, maintain a strict secrecy of all data collected. uh, Bank must, before any high value transaction, bank must verify the identity, check sources of fraud. Bank should record the purpose. For example, a 20 lakh foreign remittance must be checked thoroughly, right? Then bank should refuse transactions if verification is not possible, and bank should report transactions and monitor them closely. Risk management measures. So risk based approach, you start with risk based approach. A bank must use a risk based approach to deal with financial crimes like money laundering or terrorism financing. This means they should assess how risky a customer or transaction is and apply stronger checks for riskier ones. Bank need to have board approved policies, internal controls, monitoring system that can adapt if needed. Let's take example, a salaried employee depositing 50,000 monthly for a known source. So it will be classified under low risk. So in risk based approach, bank will classify these kind of customers as low risk, and a businessman depositing 10 lakhs in cash from unknown sources. Now this is high risk and this needs closer scrutiny. Risk assessment, bank must assess the overall risk exposure. This include evaluating who their customers are, what products, services they use, which countries or regions they deal in, and how customer carry out transactions online, in person, cash heavy. And it should be proportional, meaning big banks with international operation must do deeper assessments. A bank operating in both in India and high risk country must assess risk from that country and implement special controls. Then we classify our customers into three categories: low, medium, and high. Low, medium, and high. How do we classify them? We classify them on based on various factors like type of business they are in, the location, mode of payment, source of fund, financial and their social status. Then we have politically exposed persons. Political exposed persons are the ones who are in public, like ministers, senior bureaucrats, relatives of such person, and they are seen as high risk customers. Uh, let's understand it with one example. A government school teacher with predictable salary transactions. Now, in which category will you categorize them? You will categorize them in low risk category. A petrol pump owner who's operating large cash inflow goes into medium risk. A real estate developer operating in multiple countries with heavy cash flow. Now, this is high risk. And bank must review the risk category of each customer at least every 6 months, and immediately if a new information or suspicious behavior is detected. Risk management is not the job of frontline staff. Other departments like internal audit and compliance play a crucial role. They independently check whether staff are following KYC norms and anti-money laundering rules. These audits are reviewed by audit committee of board every quarter. Keep that in mind. So these reports are reviewed, these audits are reviewed quarterly. For example, if a bank branch fails to verify ID documents properly, the internal audit team will report this and the branch could face penalties or corrective orders. Now, new banking services like mobile banking, UPI, net banking, e-wallet, they bring convenience, but they also bring new risks. Criminals may misuse these channels to move illegal money, So bank must apply KYC AML checks before launching these new tech products. So for before allowing customers to transfer money through a mobile wallet, the bank should ensure their identity is fully verified using Aadhaar or PAN card. Now you have to train your staff, since bank staff have access to sensitive system and customer data. They must properly verify uh, during recruitment. So you train them regularly on risk related to money laundering and terrorism financing. Bank must also screen third party agents like loan recovery agent, DSAs, business correspondents. So before hiring a recovery agent, the bank checks police record, PAN and references. Also, staffs are trained to detect fake documents and suspicious transactions. Now let's talk about obligations under international law. So banks are not allowed to open or operate account for people or entities which are listed by UNSC, United Nations Security Council, as linked to terrorism. So these lists include Al Qaeda sanction list and 1988 sanction list. 1988 sanction list is Taliban related. Al Qaeda list, you can understand it is linked with Al Qaeda. So if a customer matches the name on the list, bank must notify FIUIND and Ministry of Home Affairs, and the assets must be frozen as per the government official orders. Uh, let's now discuss FATF, Identified Jurisdiction Financial Action Task Force. So this FATF identifies countries that don't follow proper AML CFT guidelines. Bank must take extra care while dealing with such countries. What banks must do? They should carefully check transactions involving those countries and document everything and be ready to explain the reason for the transaction to RBI or other authorities. Let's take an example. If a customer wants to transfer funds to a high risk country like Iran or Syria, the bank must investigate why, who is receiving it, and keep all related documents. Correspondent banks. So when one bank, say in India, works with another bank, say in UK, to provide services like fund transfer, so this is called correspondent banking. These relationships carry international risk. Hence, bank must have policies on how to form such relationship, verify the correspondent bank's background and compliance strength, and then never deal with shell banks, fake banks without physical presence. The correspondent bank holds deposit and provides services on behalf of another bank called the respondent. Bank should take all the precautions before partnering with such correspondent banks. So when Indian bank partners with foreign bank, Indian bank needs to check whether that bank follows FATF standards, who their customers are, and in which jurisdictions these banks are operating under. Reporting under FATCA CRS. So under FATCA, it is US law. CRS is global standard. Bank must identify customer who are in FATF. It is the banks must identify customer who are US taxpayers or tax residents of other countries, and they report their accounts to authorities who will check globally. So FATF is a US law. CRS is common reporting standards. If an American living in India opens an account, the bank must report this to Indian tax authorities who will inform the US tax departments. Reporting obligation to FIUIND, a bank must submit following reports, these four following reports. Number one, cash transaction report, also known as CTR, where cash transaction or withdrawal is equivalent to 10 lakhs or more in one go or multiple smaller groups. Number two, cross border wire transfer. Cross border is international wire transfer. So whenever a person sends money internationally, we call it a cross border transaction. So if the transfer is 5 lakhs or more, then these reports are to be sent. NGOs receiving more than 10 lakhs, and counterfeit currency report for all counterfeit currency notes. These four reports must be sent to FIUIND by 15th of every month. Suspicious transaction report. It must be reported within 7 days of spotting any suspicious activity. Even non-cash, completed or locker misuse activities can be reported. Does not um, have to be monetary. So even non-monetary or attempted transactions are to be reported. For example, a customer refuses to share source of fund, deposits large cash regularly, and avoids giving documents, then the bank must file suspicious transaction report. If a bank fails to follow these rules, then um, it may face warning from FIU or RBI. Action orders can be taken, corrective action orders, or penalties can be imposed for violations ranging from 10,000 to 1 lakh per violation. So if a bank delays STR filing by 5 days, it may fine a minimum of 50,000 rupees. Then we have secrecy obligation. Bank must keep customer information confidential. They cannot use it for any marketing purpose or give it to outsiders unless it is allowed by the customer or required laws. Again, there are certain exceptions. So there are 4 exceptions. If the law requires it, the bank can share the data. If it is in public interest, say for preventing the fraud, if it protects the bank itself, or if customer gives consent, whether verbal or written, then bank can share their data. I hope this unit is clear to you. Now let's move on to some questions. What is the objective of KYC? So objective of KYC are to ensure appropriate customer identification, to monitor transaction of suspicious nature, to ensure that the customer would not deceive the bank, to ensure if loan is given, it would not become an NPA. So objective of KYC is to ensure appropriate customer identification, to monitor a transaction of suspicious nature, making option E as the correct answer. Bank appoint dash who is responsible for submission of reports to FIU IND. It is the principal officer who is responsible for the submission. Customers are typically categorized in 3 risk categories: high, medium, and low, medium, and high. Directors FIU IND can take action against Dash for violation of PMLA obligations. The bank, yes. The principal officer, yes. Any employee, yes. So all of the above is the correct answer. Non-profit organization transaction reports pertains to Dash in the account of NPO. Cash transaction, all transaction receipt above threshold limit, or cash receipt. It is C, receipt above threshold limit. We have seen for 10 lakhs or more. Yes. Now let's move on to our practice questions. Which of the following statement about money laundering and terrorist financing is or are correct? Professional money launderers and organized crime groups often collaborate to facilitate financial crimes. So this statement is correct. Terrorist organizations use financial systems similar to commercial entities involving fundraising, movement, storage, and utilization. We have just um, read about it a moment ago. So yes, this statement is also correct. The primary goal of money laundering is to directly fund terrorist activities across different countries. This is not correct. It is the primary goal of money laundering is not directly financing terrorism, but to conceal the illegal money. Right? So this statement is not correct. The integration stage of money laundering involves placing illicit funds into multiple bank account. It is not integration stage, dear bankers, it is the placement stage. So this statement is also not correct. FATF standard 2012 provide recommendation for financial institution and certain non-financial businesses to combat money laundering and terrorist financing. This statement is correct. So 1, 2, and 5 are correct. Option C is the correct answer for this question. Let's move on to next question. Which of the following statement regarding the AML framework in India are correct? The Prevention of Money Laundering Act 2002 establishes obligation for financial and certain non-financial entities known as reporting entity. This is correct. FIUIND is responsible for investigating and prosecuting money laundering crimes. No, it is the duty of ED, Enforcement Directorate, and not FIUIND. So this statement is not correct. Enforcement Directorate has the power to track, attach, and confiscate assets related to money laundering. This statement is correct. Special courts are set up for adjudicating money laundering cases and have the authority to freeze and confiscate related assets. This statement is also correct. Statement 5, under Section 4 of Prevention of Money Laundering Act, the punishment for money laundering includes imprisonment ranging from 3 to 7 years, which may extend up to 10 years for offence relating to NDPS Act. This statement is correct. For statement 3, yeah, has the power to track and attach. The primary source of money laundering and terrorist financing risk is the location of bank branches rather than customer behavior. This is not correct. Customer behavior is the primary source of money laundering. So this statement is not correct. So the correct answer would be A, 1, 3, 4, and 5. Consider following statement regarding KYC policy. The definition of customer under KYC include both the person in whose name the transaction is conducted and those acting on their behalf. This statement is correct. A bank's KYC policy must be reviewed at least once in 3 years unless there is a regulatory change. No KYC policy should be reviewed every year. This statement is not correct. The primary purpose for obtaining customer introduction before 2002 was to comply with AML regulation. Before 2002, customer introduction was practice for protection under certain acts like Negotiable Instrument Act and not AML compliance. So this statement is also not correct. Which of the following statement is or are not correct? So the question is asking for not correct statements. So for this question, correct answer will be C, only 2 and 3. ABC Bank Limited is reviewing AML KYC, AML compliance framework to ensure adherence to the PMLA regulation. The board of directors has decided to appoint senior functionaries who will be responsible for ensuring the bank's overall compliance with PMLA obligation, maintaining an updated KYC policy, and ensuring the bank has appropriate AML monitoring system in place. The bank is a private limited company and board is considering the following individuals for the role: Mr. X, Head of Operations; Y, CCO; Z, a whole-time director; Mr. A, Branch Manager, who should be appointed as the responsible functionary for AML compliance in this case. So it is Mr. Z, the whole-time director, because in the case of company, the designated director responsible for AML compliance, designated director can be managing director or whole-time director who is authorized by the board of directors. Therefore, Mr. Z is the correct answer for this question. C is the correct answer. For how long are banks required to maintain records of transaction under PMLA? It is 5 years. So B is the correct answer for this question. Which of the following statement regarding risk management in banks is not correct? Risk categorization of customer must be reviewed at least every 6 months, but a review is not required if customer transaction pattern remains unchanged. So, customer review happens, risk categorization happens every 6 months. This is correct, but it is regardless of whether the customer transaction pattern changes or not. So, this statement is not correct. Bank must apply a risk-based approach to mitigate risk, and the board must approve policies, controls, and produce procedures for its implementation. So, statement 2 is correct, as banks must implement a risk-based approach with board-approved policies, controls, and procedures. Statement 3, while assessing money laundering or terrorist or financing risk, banks should consider only the nature of business and location of the customer, as other factors do not significantly impact risk. So this statement is not correct because there are multiple factors like nature of business, location, payment mode, financial status, what is the volume of transaction. So this statement is also not correct. So this is not correct, this is not correct, this is correct. Let's read statement 4. Banks should ensure that new technologies such as mobile banking, RTGS are introduced only after incorporated appropriate KYC procedure to mitigate ML or FT risk. This is also correct. So we are asked for not correct statements. 1 and 3 are not correct. So A is the correct answer for this question. Which of the following statements is or are correct regarding the obligations of bank under international agreements? Banks are prohibited from opening or maintaining accounts of individuals and entities listed in ISIL and Al Qaeda sanction list and the 1988 sanction list. This statement is correct. If bank identifies a match with a listed individual or entity, it must report the details to FIUIND and the Ministry of Home Affairs as per the UAPA notification. This statement is also correct. Banks are required to immediately seize and transfer the assets of such individuals entities to the Reserve Bank of India. So bank must freeze these assets as per Ministry of Home Affairs orders, right? And they are not required to seize and transfer them to RBI. So this statement is not correct. Any other UNSC resolution circulated by RBI must also be noted by the bank. This statement is correct. So 1, 2 and 4 are correct. So our correct option will be option B. How often does FATF issue statements identify countries that do not sufficiently apply FATF's recommendation? It is every 4 months. So FATF issues a statement of countries that do not or insufficiently apply the FATF recommendation once in every 4 months. The correct option will be option D. Which of the following statement about correspondent banking and FATCA or CRS are correct? Correspondent banking involves a one bank correspondent holding deposit of other bank respondent and providing payment and other services. This statement is correct. Respondent correspondent banking does not pose any risk related to money laundering or terrorism financing. This statement is not correct. Banks should not establish correspondent relationship with shell bank. This statement is correct. FATCA requires financial institutions to report accounts of US persons to the US IRS or relevant government authorities under an intergovernmental agreement. This statement is correct. CRS applies only known CRS applies to all foreign taxpayers, not just US persons. So this statement is not correct. Banks must be cautious while dealing with correspondent banks in jurisdiction with strategic AML or CFT deficiency. This statement is correct. So statement 1, 3 and 4 and 6. 1 is correct, 2 is not correct, 3 is correct, 4 is correct, 5 is not correct and 6 is correct. So our answer for this will be option B. What is the penalty for a bank or its employee for non-compliance with PMLA? Minimum 10,000, maximum 1 lakh per violation. C will be the correct answer for this question. I hope Unit 2 is clear to you. But again, if you have any doubts, you can ask us on our Telegram group channel, JAIIB CIB Prep. Till then, um, bye bye, take care, and we will meet soon with Unit number 3.